You're listening to The Moose and the Loose, your 10 minutes action-packed financial podcast with your host, Mike Yahoo. Hey, what's up, Market Moose? Mike from the Moose on the Loose. Happy Canada Day. So last week, I did a special episode about my favorite Quebec-based companies. I forgot a few of them, actually. They were like good comments on YouTube. So I'm sure that that's what's going to happen today with my favorite Canadian companies. Of course, all companies based in Quebec has been deleted from this list. So I'm just focusing on other Canadian companies, trying to have a focus a little bit more on companies that operates in Canada. Not always easy, actually, to have like 100% companies doing business in Canada. But anyways, so what I wanted to do this time is to go sector by sector and highlighting like one of my favorite company per sector. So let's get started in alphabetical order. The first one is communication sector. Well, communication sector, not an easy one these days for Canadian companies, right? Favorite, at least, still my portfolio, Telus, has been able to generate some solid free cash flow over the past 2 years. So cash flow from operation has been increasing, free cash flow as well, and lower capital expenditure, lower capex. That is the combination I was looking for. I was happy to see Telus increasing their dividend by another 3% last quarter. So telling me that, yes, it's a high yield right now, not so much growth, but generating enough cash flow that management is confident in its future. So I was happy to see that. Definitely not a big performer in my portfolio right now, but they just did enough to keep their place in my portfolio. Moving on to consumer discretionary. Of course, my favorite one would have been Dollarama, but I already told you about it last week. So second place, 100% pure Canadian Tire. This one is quite volatile. I like the fact that they focus on selling their own brands, similar to Dollarama actually. About 45% of what they sell is their own brands, and that is good for the control of the product, of course, because no one else can sell their stuff. And the other thing is margin are also better. So two key thing here for Canadian Tire, they're doing great. They have been doing a very strong comeback as of late on the stock market as well. Keep in mind, this one will go up and go down following the economy, but definitely buying Canadian will help them a lot. Moving on to consumer staple. There, of course, I would have told you more about IMO.TO, but one that actually surprised me and kind of convinced me it was a really, really robust business, not just like a recession play, is Loblaw. And don't forget, don't worry, I will list all the tickers in the show notes and also on the YouTube channel, so you won't have to take down notes. Loblaw, similar playbook than Dollarama and Canadian Tire. They focus on their own brand, the No Name brand, which is that became kind of like one of like the strongest brand in the grocery stores. So even though they operate in a highly fierce competitive market against Metro, against Empire, then you have like Costco and Walmart and Amazon, yet they have been able to show a very strong dividend triangle. So I must admit, I'm a bit surprised. I thought at one point that there was like an overhype, but it keeps on going up. So very, very solid business. Definitely a good recession play as well. Whenever you think that there's a recession, this is the type of stock that you want in your portfolio, because you won't lose a minute of sleep over Loblaw. That is for sure. Energy sector could have gone for either Imperial Oil or Canadian Natural Resources. Since I have Canadian Natural Resources in my portfolio, I'm going to keep this one. If you want to know more about the comparison between both, I did an episode on the Moose, last week, actually, on last Wednesday on the 25th. CNQ sitting on super high quality asset. They can manage their production. So whenever the commodity prices are higher up, they can ramp up production. And if not, they just slow it down. It is a cash flow making machine, using the cash flow for either making great acquisitions. So they just recently bought about a year ago assets from Chevron. If not, they're paying down debts and they're increasing their dividends. So 3 moves that I usually like. Oh, buying back shares as well. So 4 moves that are making a lot of sense. So CNQ, definitely an interesting play in the energy sector. A rare one that I love, mostly because whenever there is a oil bust or like big problems, instead of cutting down their dividend, they show resilience and they keep their dividend streak alive, which is quite rare actually in the energy sector. Financial sector, of course, National Bank would have been there, but second place here, Royal Bank. There are a lot of other great candidates, to be honest, but Royal Bank is one of like a good holding in my portfolio. Largest bank in Canada, well diversified. I love the fact that they play on wealth management, insurance, capital markets. They play everywhere. This is one thing that I love about them. And because of their size and their diversification, this is kind of like a play either on growth and also a defensive place. They play like it's a two-way player on the ice, definitely. Like offense and defense, they're everywhere. That's a Barkov, definitely right there. I could have talked about TMX Group. I could have talked about Brookfield as well. There are several great companies in the financial sector. Almost too many companies. Intact Financial as well. Anyways, I already gave you too many names. Industrial. I have grown a great interest into Stantec over the past 18 months. It came on my radar, and then I started following the stock, doing more analysis, and I just love this engineering firm. They are present in every single step of an asset. So planning, constructing, building, maintenance, decommissioning, everything. They have like a very great focus on like building like greener infrastructure, more efficient, which is definitely up with the trend. They keep their client, they sell more services to their client, they grow by acquisition. Stantec is just a machine. They have like huge backlog going forward. So definitely a great play today, but the future looks great for this one as well. All right, there are like 3 more stocks to this one. I have 3 minutes left, so I'm pretty much on timing. If you are curious to know where I get those ideas, well, I usually start all my research using the Rockstar list. So the Rockstar list is built from the DSR stock screener, the platform that I've built. So I just focus on companies with a positive dividend triangle, only companies with revenue growth, earnings growth, and dividend growth. So when it's positive for the past 5 years, that's a great start to look into those companies and find probably like some of the best performing stocks on the Canadian market. So you can download the list for free and do exactly the same thing as I do at moosemarkets.com/rockstars. moosemarkets.com/rockstars makes your life so much easier to select the next stock that you want to buy. So information technology now. Again, in the technology sector, you know me, I love this sector, but I love to buy in the US. On the Canadian side, it's not a dividend grower. It's barely a dividend payer, but Consteallation Software. And yes, you're going to tell me, oh, Mike, it's overpriced. Well, it was overpriced at $2,000. Now it's close to $5,000 and it's still overpriced. So you get the feeling it's always going to be overpriced as long as the company is able to run this marvelous playbook, which is making a series of acquisitions months after months to buy smaller businesses, apply their playbook, and just generate more cash flow. It's a playbook that works. It's a playbook that is going to work. That's pretty much the only limitation that Consteallation Software has, but so far they have done an amazing job and they keep on grinding. Into the REIT, if I want to be like 100% Canadian, I would go for CT but I already talked about Canadian Tire, so I went for the stock that is in my portfolio, Granite. The numbers are there, my friend. The numbers are there. The performance sucks. I'll be completely transparent with that, but I still hold this one with a smile because the numbers are great. The funds from operations is growing. The FFO per share is growing. The dividend per share, distribution per unit. Let's like let's use the right terms, is also growing for more than 10 years now. I do love Granite, even though the market doesn't love it back, and that's totally fine with me. Sometimes you have to keep on those things, but I mean, Granite is still racking up like good dividend, increasing it, following like beating inflation with that. So that's kind of like a bond in my portfolio, so I'm happy to hold it anyways. Last but certainly not the least, in the utilities, Fortis. Fortis is like the mother of dividend growers in Canada. More than 50 years of consecutive dividend increases. They are super boring, 99% regulated utility business. So they just provide power, and there you go. Canada, US, a little bit in the islands as well, but mostly Canada and US, doing an amazing job over there. Special mention to Hydro One, though. It's not in my portfolio, Hydro One, but my God, the dividend triangle on this one doesn't even look like it's a utility stock. So you might want to look into this one as well. So, right, moves. 10 minute 30, probably like 17, 18 ideas out of like 11 sectors. So I hope that you have enjoyed this rapid fire Make Great List of Canada Day. Enjoy your day. Celebrate the proudness of being Canadian. I'm definitely proud to be Quebecois, and I'm proud to be Canadian as well. We love an amazing country. I wish you a great day, and we're going to talk again tomorrow, doing a deeper dive into Couche-Tard's latest earnings that happened last week. What's happening with this stock? You're going to know more tomorrow. Until then, don't forget to stay invested. Hey, welcome to the disclaimer. If you're listening to The Moose and the Loose, you cannot really expect me to give you buy or sell recommendation or financial advice, right? You're here for fun, you're here for information and some entertainment. But I am not your financial advisor, I am not your broker, so therefore I'm not liable if you're losing money after listening to the podcast. If you're looking for some advice, go see a professional. If not, you can enjoy this show and do your due diligence after it.